Hello, I'm Chip Stites, and this is The Laughing Retirement. Today we're going to look at 2025 because to anyone who pays any attention to almost anything, we're going to go through some major changes. And these changes are not likely to be short-term. They're likely to be longer-term. And so I thought I would address this and what you might consider doing, whether you are within 5 to 10 years of retirement or whether you are young. Both things apply here. And I think you can make a difference in your life by watching this video. So without further ado, let's do a share. All right. So what's the lay of the land in 2025? And what to expect, and then what to do with the major changes that are coming ahead? Well, it's obvious. We're dealing with a lot of things. We got a new administration. We have a new government department, and that's huge. The Department of Government Efficiency. It's interesting to me that they want to save money and they create a whole new department. So we'll see how effective DOGE is in saving the money that it wants to save. There's an effort to cut government expenses. And anytime you cut government expenses, you eliminate people, you eliminate areas, you change procedures. That's gigantic for everybody. There will be a restructuring of government procedures. And that is going to affect the markets as well. We're also talking about national security. So we're talking about a wall. We're talking about Canada. We're talking about Mexico. We're talking about Greenland. We're talking about the Panama Canal. This is not small stuff. We're also talking about tariffs and therefore inflation, because generally tariffs raise inflation, but not so much if these tariffs actually bring jobs home, which is, I think, what the president-elect is expecting. So we also need to think about and look at what happens when the government raises or lowers rates. Now, we tend to think that the government raises rates and therefore all rates go up in concert, but that's not the case. The government's actually been cutting a little bit over the last year or so, but the 10-year note has gone up 100 basis points, a whole point. That's gigantic. And it shows very simply that just because the Fed is cutting rates does not mean that you will see a rate cut in what you have. For instance, the 10-year note is very often the thing that governs where mortgages are. So because they cut, mortgages haven't gone down. Over the last year, they've gone up. Back to normal, if you will. So don't think that just because the Fed is going to cut rates, and they say 2 more times this year, that you are going to see a change in what you have. That may or may not be the case. If we get jobs coming home and we get more factories built here, that's good for the economy. It's good for jobs. It's good for the economy in general. That may help inflation come down. There's an AI boom, but we're still in the early stages of this. And so it's awful hard to tell who is going to be successful, why they are going to be successful, and what success actually means. So because there's AI there doesn't mean you should leap in and invest in it. Now is the time for simpler, for less expensive, and for broader-based 401k long-term investments. We make a mistake when we take short-term investments and we put them in a long-term account. What do I mean by short-term investment? Well, when I was working, one of the things I did was I would do a group of mutual funds. I would help people put them in a 401ks because I ran multiple 401ks. And then the next year, I would look at them again and make changes. Well, that's short-term thinking for a long-term investment. And what I've learned since I got out and what I've read, John Bogle, Warren Buffett, Jeremy Siegel, Mark Lichtenfeld, Charlie Munger, what I've read says just the opposite. Man, there's a part of me that does this because I want to help people, but also a part of me that wishes that I had known what I knew now then. What a difference that would have made. So with inflation, there's greater value in bonds. And when there's greater value in bonds, it may make sense to change the construction of and how you are looking at your portfolio. So that's another thing we're going to talk about. What does this mean for your portfolio? Well, many changes equal market uncertainty, and markets generally don't like that. Higher inflation is good for bonds and things that have brick and mortar, like real estate investment trusts. It's bad for spending in debt, and it increases the volatility in portfolio. Now, if you want to decrease your portfolio, if you're within 5 to 10 years of retirement, you may want to take your portfolio and increase the bond part and decrease the stock part. Now, one of the things I read said this is an ideal time for a 60-40 portfolio. It's also a great time to be young because volatility means that stock prices are going to go up or down, up and down all the time. When stock prices go up and down, if you're reinvesting dividends, now you can make some money. So if you're young and you want to learn a system like this, and I'm looking at one thing for those of us who are trying to stay young, and one thing for those of us who are young. So it's a good time to lower risk. If you're within 5 to 10 years of retirement, I would lower risk without any discussion at all. Greater inflation is better for bonds in general, and it becomes slightly worse for stocks. Greater inflation increases the long-term returns of bonds, and so you might want to look at a 60-40 portfolio. Reduce expenses. Now, when you reduce expenses, you're putting more of your money to work. Simple logic. Reduce expenses. Warren Buffett said the enemy of the equity investor is expenses and emotions. Well, you can certainly control your expenses. You can move from mutual funds to ETFs. You can take a fund that is costing you 0.87% or 1% or 1.25%, and you can change it to 0.05% or 0.03%. You can lower your exposure to high-risk investments, growth-only investments. You can do more things across the board. If something has a high turnover, you might want to look at replacing it. You can increase exposure to bonds and preferred stocks. You can consider an ETF portfolio based on simplicity. And who espouses this idea besides me? I got it from reading this book. It's called The Little Book of Common Sense Investing by John C. Bogle. John Bogle is the founder of Vanguard Funds. He said in a testimony before Congress, and here's his whole testimony before Congress right here. He said, I conclude that the high cost of ownership of mutual fund shares over the long term are likely to confiscate as much as, there's a mistake, 65% or more of the wealth that retirement plan investors could easily otherwise earn. 65%. 65%. As a matter of fact, let's take that and let's do this with it. In other words, if you save $400,000, if you lowered your expenses, you could be saving $800,000. Now, I didn't believe that when I first saw it. And what I did was I did a complete spreadsheet. If you want to talk about it with me, I'll be happy to show it to you. I got nothing here that's secretive or anything really special. It just makes sense. It's common sense. The number I came out with is closer to 50. It costs you, your expenses cost you 65%. He said, I said 50. So if you save $450,000 or $350,000, you would have 900,000 and 700,000 instead. Now, which would you rather have? Again, this is a guy who knows. This is a guy who was in the business. This is the guy who started Vanguard funds. Don't listen to me. Reduce your expenses, reduce your risk, and look for consistency. Consistency over time is one of the things that spells wealth. How do you think foundations get along? This is exactly what they do. Now, if you're within 5 to 10 years of retiring, consider, please, changing from a mutual fund portfolio with a ton of different mutual funds in it, most of which overlap the same thing in more than one fund, to an ETF index style portfolio with expenses of less than 0.1% and low turnover. Use a 60-40 portfolio of less than 5 investment. This gives you simplicity, lower risk, lower expenses, and it's not something you have to worry about. Now, I have a list of 60 mutual funds that you can help put together, that can help you put this together. I'm not saying they're the best funds. I'm not saying they're the only funds. I'm saying that there are ETFs that can do this for you. Let's look at one example that I've created here. It took me 5 minutes. PBUS, 30%. That's a large cap blend. SMLV, this is a small cap blend, 15%. DOL, this is a foreign large cap value fund, 15%. Now that's 60% right there. Then IEI, that's intermediate bond index, 40%. So there's an example of what you can do. And you can set it and you forget it and you walk away and you look at it a year later and you don't worry about it. Now, what do you do if you're younger? Supposing you're not within 5 to 10 years of retirement and you're in your 20s or your 30s. Well, it makes sense to use the eighth wonder of the world, compounding interest, in this case, compounding dividends. Now, Mark Lichtenfeld cited a guy who worked for Ned Davis Research who said and proved that 95% of return from the S&P 500 comes from reinvested dividends. Why wouldn't you want to take advantage of that? Create a dividend portfolio outside of your 401k so you can create tax advantages and control a growing income every year. You can retire earlier. You can live better and learn a skill that will stay with you for the rest of your life that you can teach your kids when it comes time. Increase and invest in the stock that compound and grow their dividends every year. And I can show you how. Here are some examples. I own many of these stocks. They increase their dividends every year, and there are a ton more than this. It is not difficult to do, regardless of what you have been told. If you would like to talk to me about this, whether you're 55 or 25, book a free chat, and we'll sit and talk about what you might do and how you might do it and how you might learn this. Now, results for the young and those staying young. If you want my free ETF list, send me an email at info@thelaughingretirement, and in the subject line, put ETF list. That's all you got to do. Put ETF in the subject. I'll be more than happy to send it to you. If you want to ask me a question along the way, go ahead. If you would like that list and you would like a free 20-minute chat, follow this link. Get a free 20-minute chat. I'll be happy to talk to you. Listen, The only thing I want you to do is take charge of your life, of your financial life, and realize how important doing that is for your retirement. If you want to understand what I believe, why I believe what I believe, and what I do, look at my YouTube channel. Look at the 20 plus videos, generally less than 20 minutes, that I have in which I explain what I do and why and how I do it. Watch our masterclass. Learn a simple method of creating a life-altering wealth that is consistently growing for you and your family. Ask me about why I think expenses are so bad and why I think people worry about having enough to retire on is partially because of the 2% expenses. Notice I just said 2% and what a difference that makes to you. I can prove it to you. Book a free 20-minute chat and I'll show it to you. Believe me, when I say you can control your financial future, you don't need anybody else to tell you what to do. It's not genius. If you have 3 hours a week, I can help you change your life. So book a free chat, ask for the ETF list, and have a great 2025. Thank you.